Apple announcing all its retail stores outside of the Greater China region. They are closing now until at least March 27th. Take a look at shares of Apple. Let's show you where things stand right now. $245.85 off right now, about 11%, almost 12%. Let's bring in an investor voice on the impact. Joining us right now is Peter Kraus. He's the chairman and CEO of Aperture Investors. Good morning to you, Peter. We can talk about Apple, but I also want to talk about the broader market. Let's talk Apple first. To the extent that that's a barometer or a indicator or a signal of something, what is it?
Well, Andrew, I think that Apple is probably a microcosm for what we're seeing in terms of demand impact around the world as a result of the coronavirus. That demand impact is likely to be in evidence for the next few months, and I think you see the markets reacting to that. If you take the human element out of this, which is of course impossible because we're all affected by this, and you look at this sort of objectively, we probably have a 3-month to 6-month interregnum where demand's going to be significantly impacted on travel, leisure, consumption, which is a major part of the U.S. economy, restaurants, hotels, all the things that we've talked about, stores, and that's likely to have and is having a significant effect on the market. So I think Apple is just a microcosm of that demand impact that we are seeing.
Peter, what are you telling your clients? And I remember all too well, unfortunately, 2008 and that infamous weekend that you worked so hard on behalf of Merrill Lynch after having just gone over there. But as you see this playing itself out, you're telling your clients what?
Yeah, it's a great question, Andrew. You know, I've been through about 5 crises or 5 market crashes starting in '87. This was '87. It was the Russian debt default in '98 and long-term capital. As you remember, I was sort of in the middle of that as well. Then there was 2000, then 2008, and maybe even 2011. This market crash reminds me much more of 1987. Sharp, emotional. '87 markets were actually had a very hard time catching up. They dropped precipitously in a very short period of time. The '98 crisis, it was actually similar in that sense, in that there was very little liquidity in the bond market, and you see that now. 2008 was a different issue because 2008 you had in the center of the financial institutions in the world, you had serious questions of viability. That banks were not going to survive, that large financial institutions were going to collapse, that funding was going to dry up, and that banks would not be able to survive that. That was an existential threat to the financial system. We do not have that. We are not at that point.
So you feel confident in the strength of most of the large American businesses today?
I feel confident in the strength of the U.S. and global financial system, and you can see that in the reaction that the central banks around the world have taken, and indeed even some fiscal response that's already starting. As to all of the corporate balance sheets, I think I'm not saying I'm not confident in that, but I think that's a much more disparate and harder to understand.
But look, Peter,
problem.
I think what a lot of investors are trying to do, and I was talking to CEOs and major investors over the weekend, and they were literally trying to math out if, in fact, because of the social distancing efforts to try to end the spread of this virus continue for many months, what that ultimately looks like, what the balance sheets of these companies look like. Can they withstand it? What happens to the auto industry? What happens to the airline industry?
We'll be able to maintain a demand shock of that magnitude for 3 months. That's not out of the question. Lenders are not going to collapse onto these companies. They may have defaults. They may have technical defaults. And some companies will declare bankruptcy for sure. But 3 months is achievable. The system is not going to fall apart in 3 months.
Okay, so if you're right, if you're an investor today, you look at what's happening, you see where markets are, limit down right now. The ETF suggesting it's going to be worse than that. You're looking at the Dow off pretty much everything about 10% at this moment. By the way, that's effectively just giving up the gains of last Friday.
Which was effectively just making up for the gains of last Thursday.
Last Thursday.
Up and down.
What do you do? Do you put money to work right now? Do you say that there's more to go here? How do you think about it?
So look, I like to think about these markets as to what their implied risk premiums are. If you go back to 2009, the implied risk premium in the market was almost 900 basis points, maybe 1,000, which implied a multiple at the bottom in March of 2009 of 8.5 times. Now, that's with interest rates at 3+. Interest rates now are at 1 or less than 1. And so you could easily have a risk premium here of 6 or 7%. I don't think it requires the kind of risk premium you saw in 2008. And that would imply a 14.5 multiple. And if you think that $160, which is what the S&P earned in 19, is going to be what it's going to earn in 2021, which I think is reasonable, you know, that's a market in the 2,000 to 2,300 as a bottom. So, you know, we're at 25.50, I think, on the futures. Obviously, they're going to go lower. If I had cash today, I would be buying the market in some regimented and disciplined way. You're never going to get the bottom. The market will recover. We've been through this before. I'm not telling you that it's going to be easy. It's not a walk in the park. This is a challenging market. There's not much liquidity. There's a lot of fear. Markets are going up and down 10%. That's not the first time it's happened. It won't be the last. But, you know, the global equity markets will survive, and there are interesting investment opportunities here.